You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, the monthly update series for March 2013. And on today's show, the life insurance underwriting update with our special guest, Jessica Lopez, life insurance news reporter.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 2 in a row, Jessica Lopez. Hey, Jessie.
Hi, Steve.
Well, I always tell Jessie to go out and fish in underwriting and find out what's going on out there. And this is so broad because, we do thousands and thousands of cases. Not all of them are substandard, not all of them are impaired risk, but we get our share. And what I try to do is I try to find out who are the players are. And what Jessie does is she goes out, sorts down what are the anomalies. What case, how distinctive is the underwriting? And there is some benevolent underwriting to be had. And so I just want to go through today's show is to walk you through some of the carriers, and we have kind of a potpourri, good inventory today.
We sure do.
And I want to talk about why they're winning. And the biggest issue I want to keep exhorting everyone here is some of these numbers, the target premiums are gargantuan. And the first one is, think about this, the first case we're going to talk right out of the chute is 116,000 plus annual target premium. I mean, I'm sorry, I love that case.
That's a nice paycheck.
Talk about this because AXA, again, of course, and of course, Kathy, Kathy Fell, head of underwriting, we love her. And so of AXA, talk a little bit about this case though, because it's a monster case from a 6-figure premium point of view.
It is, absolutely. And we love the challenging cases, and this was one of them. In this scenario, we were working with a 56-year-old female client who needed $10 million in life insurance. The challenge here was that basically the client and her advisor were comfortable with a guaranteed death benefit into her mid-30s with a projected death benefit through policy maturity. Now, the client's financial plan called for a long-term flexibility around the amount and timing of premium payments, making a policy that generates significant cash value an ideal solution. So what we did is we went to AXA and took a look at their Athena UL product. Now, basically what we did is we took and designed minimum funding cost while allowing the non-guaranteed death benefit to run to lifetime. The policy generates significant cash value throughout with a peak at 34th year policy, creating the flexibility and premium funding the client required. So in a nutshell, the guaranteed death benefit lasts until the 30th policy year of the client's age 86th, providing guaranteed security through the life expectancy.
Yeah, remember, this isn't even substandard. We're talking about using a product that plays both sides of the fence, generally something I don't like, because now we're combining indemnification and income on the same mortality chassis.
Right.
I usually don't like that. It's usually, to me, that's heretical. But from this case, this was the planner, they both agreed to this, and think about that, AXA's Athena UL actually fit that profile.
Absolutely. Now, next on our list was a case that we actually had written with Lincoln Financial. In this scenario, we're working with a 74-year-old male was attempting to replace $4 million of current assumption UL coverage with $4 million of NLG coverage guaranteed to age 95. Now, the replacement only made sense if the proposed insured could qualify for preferred rates. So this was the challenge.
But he has prostate cancer.
Right. The obstacle was clearly that he had prostate cancer from 2005, causing most carriers to basically say, you know what, standard is what you're going to be.
Right.
Now, ultimately, what we're able to do is to go through, work with Lincoln Financial's underwriters. They were able to go ahead and offer a preferred
that kind of was stunning to me, I have to say.
And the target premium on this case happened to be $172,000.
$172,000. I love that. I mean, when I'm looking at that, again, when they first said it's preferred or nothing, I'm like, well, fantasy and reality. Okay.
Absolutely.
And now this next case by Lincoln Benefit. Now this is kind of a strange one. And again, people say, Steve, where do you get these cases? This case is $400,000 of annual target. I just can't believe we get cases this size. This is a big case.
Yes, it sure is.
Talk a little bit about this case.
In this scenario, we're working with a 70-year-old female looking at, again, $10 million for estate planning needs. Basically, this case was shopped around. There were some major medical concerns here. Cardiac, left bundle branch block was the main concern. And basically, a current cardiac evaluation was able to allow us to get a better rate. So we were able to go ahead and get the case placed at the $400,000 target.
$400,000 on a bundle blockage. I'm just saying, I'm always amazed at the kind of numbers. And remember, when healthy people become unhealthy because they're spending their time on building their wealth,
right?
This is an excellent way to retrieve that and argue successfully. Remember, a lot of carriers are seeing these cases.
Right, and it's one important thing to remember is, a lot of times we can get these decisions turned around, or at least better the offer, with the client simply going back to do the follow-up that maybe they didn't do. And a lot of times it is going to turn out for the better. Most of the time it is. If not, then that's another situation. But, I quite often see cases that come back approved other than applied for, postponed, and it's for that reason. The follow-up just didn't quite happen, or perhaps the records are somewhere else not included in the primary care.
It's really important, especially when you do deal specifically in impairments, that you really look at who are the carriers in that specific disease, because they don't treat, everybody's different. There's certain carriers, like for example, I won't say the carrier's name, but type 2 diabetes, I will never send it to that carrier. It'll never see the light of day. I know they're not really good at type 2 diabetes underwriting. They just are not. So they'll never see it. So when I see a major impairment that's dominating the client file, I'm going to cherry pick the carriers that match up to that. And then I look at the product to see where is it going to lay out when I price it.
Exactly.
And the bundling that they do in traditional underwriting that Jesse's been doing for years, this is what they're looking for. They're really seeking out what carrier and product line are going to make this happen.
Absolutely. And we actually have a guide that you can use to basically help you determine which carrier is going to be the best fit, and then you can contact us and we can really get as close as we possibly can on a prelim or informal basis.
And remember, I am certainly not shy about getting on the phone and really arguing in a very intelligent way if I have additional lifestyle credits that I can add to the credit balance sheet and tip that to the next level, a better underwriting offer. I mean, that's our goal. When we come back from the break, we're going to continue our monthly life insurance underwriting update for March 2013 with Jessica Lopez. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Jessica Lopez. And don't forget, you can request today's material just by emailing me, steve@thebiz.tv. And just a heads up before moving forward with any of the ideas you ever hear on our show, although we're not really talking about taxes and planning today, but always consult your tax advisor or legal counselor before you move forward. And if you're FINRA licensed, your broker-dealer compliance department. I just want to keep our T's crossed and I's dotted. We're talking about our life insurance update with Jessica, and we're going through cases. And some of these cases are big cases. This is not as big, but I don't think anybody in our audience would cry if I had a $62,000 target to place.
I'd take that all day long.
This. And this is Protective again. Coming to the plate with their 2 manual, the way they understand, they kind of use 2 manuals to kind of get their own idea and how they underwrite. Talk a little bit about this case.
Well, again, this is with Protective. We're working with a 70-year-old female. Basically, her goal was to purchase $2 million in coverage. She had a family-owned energy business, so she wanted to have that protection in place there. She had recently placed $3 million in estate planning policies with Protective Life at a standard rate, so it made sense for her to go back there. The primary concern here was basically that the financial justification, so forth, of the policy, but really going through and taking a look at the business, her personal assets, and so forth, they were able to go ahead and approve the $2 million additional policy at $60,000 in target.
So it was additional coverage.
Additional coverage.
And was there an issue, you said, did I understand you right, on financial suitability on this?
Basically, yes. What had happened is the underwriter had requested more information. We needed a detailed letter from one of the signing officers, going through, tax returns and so forth, just to kind of dig through and make sure that we're justifying the purchase of the new policy.
Now remember, it's always an issue with indemnification. We have to validate the financial liability.
Right.
And so it's not, to me, when I see, there's certain carriers that are really, if this was only financial and not any other issues, I might have went someplace else on this, but this was a nice kind of a tag team approach that Protective did on this case.
Exactly, because they had already gone through the whole underwriting aspect of everything. She got a decent rate, standard rate, and decided to go ahead and keep it there. And one thing I just wanted to point out with Protective too is, they did a lot of things the right way over the past several months into last year. So they had a huge influx of business.
Well, until last year, or did it continue this year?
Well, this year and this year as well. So 2012, no, it's still happening. And we've been working closely with Protective as well. Updates from them, they've actually hired several underwriters as well as case managers.
And their product is moving up the ranks. Hey, I love that.
It is, so hence the influx of business that they've had, and I know turnaround times with that company are going to greatly improve as well.
Yes, we hope.
Yes.
Now let's talk about this Aviva case. Again, another $275,000 of annual target premium. I mean, this is a great case.
Right. This actually had to do with a 79-year-old male and a 79-year-old female. Basically, they're looking for a SVUL contract, and the idea was for them to replace what they had. The clients required a standard offer on the wife and a table 6 on the husband. Now, with the AG 38 deadlines that were fast approaching, this was at the tail end of the year. Right. Of course, we need to get that in. Underwriting had to step it up. And as everybody knows, when we're talking about a scenario where we have multiple sets of medical records, expediting that, getting it over to the underwriter, they have to sift through all that information, and to get it done for $275,000 in target, it's pretty amazing.
Well, not only amazing, but I'm sitting there, when I think about now, the whole reason this case even got seen was because of the issue of guaranteed to 95. When I first read this case, I'm going like, well, if I'm sitting there at table 3 and 4, what am I worrying about living to 95? I mean, I don't see the mortality. But you remember, people are very conscious about what's happening in their life, and this couple, who knows what technology is going to happen, going to do. They want to go to 100. They want to see age 100, age 15, 120. At first blush, I would have said, who cares?
You're right.
But this is why we look at cases, because I go to the client and say, based on your mortality, you really don't have to worry about it. You probably should leave the contract in force. But they were concerned that, yes, they want to make sure that this, so we were able to move the policy to another policy that actually extends the life, and by the way, at the request of the client.
Right, absolutely. Next on our list is MetLife. And in this situation, we're working with a 65-year-old male looking for $1 million. The client is not only looking for death benefit protection and is not interested in cash accumulation, so just guaranteed is what he was looking for. In a nutshell, what we were able to do is take a look at the provider UL with MetLife with a death benefit of $1 million and guaranteed for 30 years, or basically until the age of 95. So the MetLife provider UL is a guaranteed death benefit product with no cash, essentially to term 95, obviously. The client had some health challenges and was rated at a table D as in David, which allowed for an annual premium of $39,220 for 30 years to guarantee the $1 million death benefit to age 95. So the target on this was actually just about $43,000.
Well, of course, when we like the table rating D, it's D as in David. When we think it was a bad rating, we say it's D as in dog. But no, again, when we looked at this rating, and remember, sometimes you're not thinking through the consumer. They wanted a big name. We gave them a big name. We gave them Snoopy. So that was huge.
Absolutely right. And the last one that we have is with ING. This was a situation for a 50-year-old standard male and a 58-year-old preferred female couple seeking survivorship plan. More importantly, they had basically requested that their advisors take a look at the surrender charges on their existing policy. So what we did is basically took a look at the indexed SUL product with ING, who has strong cash value opportunity there. And in a nutshell, Steve, I know ING is an IUL carrier that we typically pull in from time to time. And in this situation, it seems like they came out the strongest. The target came out at $42,000. And a combination of underwriting and just good old-fashioned illustrating and taking a look at who's going to come out on top.
And the thing about ING in this specific case is that normally we would not have thought about them on second to die. So that's why we have to do the entire grid and spreadsheet to make sure we're always covering all carriers. Well, that's what we have for today on the show. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.